Hey everybody, this is Peter Hafner, certified financial planner and certified financial fiduciary. And I just wanted to reach out to you today, do a short video just to talk about the financial markets, about the stock market. Today is Tuesday, May 12th. It's going to be a little later when you get this, but the market has been hitting all-time highs, one after another. And there's just so much going on. We're at war with Iran. There's inflation, high gas prices. There's social unrest in the country, a lot of concern over the coming midterm elections. And yet again, the stock market keeps hitting new high after new high. And this is after 3 good years in the S&P 500. Last year, the S&P was up something like 16%, and the 2 years before that, it was up 23 and 24%. So we have really been on a good run with our investments for quite a while. And I know in these unsettled times, it can be a little unnerving if we think about what to expect for the future. So one thing I've been thinking about is just how much today reminds me of the 1990s, especially the late 1990s. And for you older folks out there, you probably remember the internet was new, email was new, and the stock market was on a tear. The Dow Jones kept hitting new high after new high after new high. Tech stocks were just out of this world, and everything kept running higher and higher and higher until one day it didn't, right? That's right. And then we crashed. The bubble burst in 2000. And the NASDAQ really came down hard. So what I wanted to do today is I want to talk to you a little bit more about the comparisons between today and the 1990s. And I want to remind you just how long the stock market ran before ultimately it fell off that cliff, because it just kept going up, up, and up. And if there's any truism about the stock market, it is that it is incredibly hard to pick where the highs are and decide where the bottoms are. And if we look at this comparison of the 1990s to today, there's a few things that are different. But what's interesting is they're different in a better way for us as investors today as compared to the way it was in the 1990s. What I mean by that is these differences actually put us on a stronger footing where it could be the market will continue to run higher and higher and higher. And there's 4 things I want to talk about. And by the way, I'm going to put a link under this video to a blog from my broker-dealer that goes into more detail on what I'm talking about here today. But the first of the 4 things that's different today compared to the 1990s is that leadership is stronger today than it was in the 1990s. And what do I mean by that? Well, what we're talking about today is it's the AI build-out. It's the artificial intelligence revolution that's taking place today. And when we look at the leaders in that sector today, compared to the leaders that were in the technology boom sector of the 1990s, these companies are much more solid than they were back then. Their business models are more diversified than what we were looking at in the 1990s. And this is a reason for us to be optimistic that the market can continue to run in a really good way for us as investors. Second thing is the valuations of these companies are much more grounded than they were in the 1990s. In the 1990s, the companies that were leading the market higher often had no earnings. They were going higher and higher on multiples that really didn't, you could make the argument, didn't make sense to where the stock prices were trading. But today, that is very, very different. Valuations back then were 58 times consensus forward earnings, and today it's only 25 times consensus forward earnings. So that again puts us on much firmer ground, much less reason to worry. The third element I want to talk about is IPOs. That's initial public offerings. They're much more rational today. The technology IPOs are much larger today with proven business models and sizable revenue streams. Even for companies operating at a loss today, it's much easier to see a path to profitability. That was not the case back in the 1990s. Back in the 1990s, the tech stocks seemed much more like a gambling casino compared to what we're seeing today. So another reason why we're on a much firmer footing today, and the market could keep on running today, even though we're already at all-time highs. And then finally, the last thing I want to talk about is the AI model that we're living through now, the AI revolution. It's much earlier in its cycle today compared to the end of the 1990s. Today, the build-out is centered around AI infrastructure, while the AI adoption phase has barely even begun. So there's really reasons to be optimistic in spite of the fact there's so much negative news today. Again, I'm going to put a link to this blog in the video so you can read it and digest all the information. And there's one more thing I want to share with you, and this is a little on the negative side, because there are so many things to be worried about. And yes, there is this AI revolution that is booming right now. And there's a tension between these two different things. But there's a saying in the markets, and it's that it's the snake you don't see that bites you. So the reason I'm bringing this to your attention is we've got our eyes on all these different snakes. We got our eye on the war and inflation and all these other things. But what could happen is something could come out of left field next week or in the coming weeks or maybe next year, sometime in the future. Something can come out of left field that takes us all by surprise. That would be the snake we don't see coming. And then all of a sudden, investors might change their mind and recalibrate where they think opportunity and risk is. And you could see a very fast change in people's opinion about the markets, and you could see things come down. So right now, looking at the evidence, I can really make the case that the future looks really bright, and we ought to be in the markets. We ought to be taking advantage of it. But this is why we have our bucket plans for those of you who are working with us. This is why we have money in the soon bucket. It's because the soon bucket is what protects our cash flows when we're retired from stock market volatility. So for those of you working with us, if you want to make sure, if you want to meet with us and talk about your soon buckets, just give us a call. We'll get a meeting on the calendar. For those of you who aren't working with us and are more interested in learning how we manage this bucket portfolio, this bucket strategy, just take a look at some of our other videos. That's everything from me today. Hope you found this useful. Hope you enjoyed it. Please feel free to share with your family and friends, and I'll see you next time.